This is King World News. I'm Eric King, and you are about to hear part one of John Mauldin's interview where we talk about the stock market, real estate, and much more. For more interviews, remember to go to our homepage at www.kingworldnews.com, where this week we have a terrific interview with Congressman Stearns discussing his exchange with former Treasury Secretary Henry Paulson and Michael O'Higgins, well known for his Dogs of the Dow theory. Joining us now is John Mauldin, president of Millennium Wave Advisors and president of Millennium Wave Securities, successful author and publisher of the weekly newsletters Outside the Box and Thoughts from the Frontline. This is from your latest weekly Thoughts from the Frontline. A lot of bullish commentators are talking about a recovery being in the works, and they may very well be right. But it is not going to look like any recovery worthy of the name. This week, we look at what I will call the statistical recovery. But first, we take a look at what China is doing as we continue our look at the rest of the world and ponder whether it is time to brace ourselves for an extended bout with the muddle-through economy, asterisk. And yes, there is an asterisk. This is going to be a long, jobless recovery. Hours worked per week are at an all-time low. There will be few new jobs for a long time. As an aside, the media talks about initial unemployment claims falling. That is actually not true. Unemployment claims are in fact quite high and rising, but the seasonal adjustments make them look smaller. Higher and persistent unemployment, lower incomes and wages, higher savings rates, capacity utilization at 50-year lows and still falling, rising home foreclosures, a deleveraging financial system, etc., are not the stuff of V-shaped recoveries, end quote. What about this talk of recovery, John? Because you seem to be injecting a dose or trying to inject a dose of reality into the high expectations some may have going forward.
There's several things going here. Some, you just got market cheerleaders who need the market to go up in order for them to make money.
Right.
If you're running a mutual fund or you're in the sell side somewhere, coming out and saying, I think it's a lousy time for stocks and, you shouldn't invest right now, you're not going to be running that mutual fund for very long. I mean, just in the same way that no chief executive is going to come out and say, our stock's priced too high and I think it should go lower. There's some of that. So people see what they want to see. They need the market to go up, so they see green shoots everywhere, if you will. I mean, in my business, we're managers of managers, and we can choose managers who don't need the market to go up to make money. So, in one sense, I don't care whether the market goes up or down from a client standpoint. So I just try to look at the market and see which way it's going, position our managers, if you will. The second thing is a lot of people wrongly read history. They go back and they say, look, and they take an average of all the recoveries and say, this is what's happened. And look, these 3 data points fit with that theory. Well, it does, but then the other 10 data points don't. But they say, well, those will sometime in the future. See, it's getting better. Or they'll look at what they call the second derivative of growth, or negative growth, I guess you could say. If something was down 16% 3 months ago and then down 10% and then down 5%, they say, look, it's less worse. The second derivative is what it's called. Speed is one thing. If you're accelerating, acceleration would be the second derivative of speed. And so this is deceleration, if you will. And so things are less bad. They're still going down. It's, you've jumped out of the airplane. You've pulled the parachute. You're going down slower, but the direction's still negative. But they say, well, it's going to bottom. And what I was writing in the letter this week, I was saying, yes, it will bottom. You do get to a bottom. We've avoided Armageddon, but that bottom is going to be further down than we've been in our lifetimes. And with all the things that you read about a while ago, increased savings, in rising unemployment, capacity utilization continuing to fall, reduced exports and imports, all sorts of unpleasant things happening in the economy, we're not going to see a robust employment picture, specifically because we have almost 10% on unemployed now and another almost 7%, as in millions and millions of people, that are on part-time but want to be full-time.
Right.
Well, employers, when it does bounce, they're going to give the part-time people more hours, and they're going to let the full-time people who aren't getting quite jobs, who aren't getting enough hours, to come back in. So we could see, just like we did the last recession, that the recession ended in November of 2001, but unemployment didn't peak until June of 2003. 21 months later. So it may look like the recession is over, and statistically, I went into reasons why it will. The year-over-year comparisons are just going to be better. We're comparing ourselves with truly abysmal stuff last year.
Right.
So the comparisons get easier. It's like my son coming in and saying, I made a C-, Dad. That's better than a year ago. Well, I'm not very happy with that C minus. And the other sense is a sense of relief. At least it wasn't a D. Okay, because that's where he was a year ago. But that's on an absolute scale. You're still not very happy with the C minus, and it's going to be a while before we get to C minus in terms of employment. The consumer has been scorched. We've seared the psyche of the American consumer. They're going to start saving even more. The only cohort, the only group that has seen their employment numbers rise has been those 55 and older, which has made it harder for those 25 and younger to find jobs. I mean, there's some sections where 25 and younger in some parts of the country is unemployment approaching 20%. That's pretty grim. That's because older people are taking any job they can find because they now realize I can't count on my pension and my home to bail me out. I've got to find somebody to buy I've got to find somebody to give me a job so that I can work longer.
Right.
Because I can't retire the time that I thought I was going to.
I want to take a little trip back in time here. This was from your piece September 13, 2002.
Oh.
Once a downward trend starts, returns over the next 10 and 20 years are very small, often less than 1%. In real inflation-adjusted terms, returns for investors can be flat or negative for decades. When you wrote that, John, the stock market was in the mid-8,000s, and just recently the stock market was again in the mid-8,000s. It's been higher, lower, but it was in the mid-8,000s. And, of course, that would mean you would have had potentially negative returns, right, when you adjust for inflation, as you mentioned. So
yeah.
This is my question for you. Hasn't the passage of time, to some degree already, supported your thesis that investors should expect very small or possibly negative returns for decades from the time you wrote that?
I think so. I was writing that a year earlier when the stock market was a lot higher because it was my thesis then. In fact, I was writing about some of it in 99, that we were getting ready to enter a secular bear and that secular bears are better looked at in terms of valuation rather than price, okay? And markets go from high valuations to low valuations back to high, but they do so over long periods of time, an average of about 17 years, anywhere from 13 to 20 years. We're only 9 years into this one, so if we were going to, not be the shortest or not be the longest, we've got anywhere from another 4 years to another 11 years to go on this trek till we get to low valuation. I was writing a piece the other day talking about, valuations are in the eye of the beholder. I mean, if you want to try to use 10-year smooth valuations or, want to use trailing PDEs, you want to use operating earnings, there's so many ways. So you've got enough stomach to listen to CNBC all day. You can hear people say, well, we're at fair valuations, we're at high valuations, we're at low valuations, all on the same day. But with the way that I like to look at them, kind of a smooth earnings stream and looking at fundamentals, I think we're somewhere a little bit higher than normal, higher than average rather. So we've still got some room to go. And it could look like 1975 to 1982. I mean, the market did go up. It went up in a very churning, stomach-wrenching style.
Right.
But valuations continue to compress. And it's that compressed valuations that give you the coil spring for the next bull market. And we haven't gotten to those compressed valuations yet. And it seems like we always do. Maybe this time is different, but that's a very, very difficult premise to invest on for me. So I'd rather look in this market for absolute returns. I'd rather try to figure out how to manage myself for lower expectations and not expect that the market's going to give me 8 to 10% from where we are today. Now, from where we are today, you can probably get 3 to 4, maybe 5 over the next 10 years. That would be consistent with history, but it's not going to give you anything like what the long-term, multi-cycle, 80-year track record that all the advisors put into their models. You're much better off looking at where valuations are than seeing what kind of returns you get over the next 10 or 20 years from the current valuations and plugging that into your model. And I think when investors do, if they went through such an exercise, which, by the way, it wouldn't be bad for me to create a little website. That shouldn't be too hard. I don't think I'm going to ask some of my tech guys to do that while I'm thinking about it. But what will happen is investors are going to find out they're going to be shocked at what expected returns could be. They're going to be a lot lower. And they're going to end up saying, I need to save even more. And the longer they go through that experience, the more we're going to see people save. I mean, it wouldn't shock me at all. In fact, I'd be kind of surprised if we don't go back to 10% savings where we were in the early 80s. And that, by the way, is a very, very different consumer society than we have today.
Correct. This was from late September of 2007. You wrote, All this means that the fallout from the housing recession is still in our future. I expect